What if the movements of global financial markets, the ones that seem so random, aren't actually random at all? What if the really big players, the banks, the institutions, what if they're setting traps for the rest of us, the individual traders?
An interesting thought.
And what if understanding their strategy is the real key, the ultimate way to unlock consistent success? Welcome, everyone, to another deep dive.
Glad to be here.
Today, we're diving deep, really deep into the fascinating and sometimes controversial world of the smart money concept, or SMC. We're drawing heavily from the Adamas Bont 1 material.
That's right.
Our mission today. Well, we want to unpack the core philosophy behind SMC, try to understand how it claims these market makers operate, and also explore, the really crucial stuff like trading psychology and risk management.
Absolutely vital topics.
And we've got some big questions based on the source material, like can you really trade like the big banks? And what does that even mean in practice? Are market movements genuinely manipulated? Or is there maybe a more nuanced truth behind it all? It's complex.
And maybe the biggest question, how much of trading success is really down to the strategy itself versus, well, something else entirely, like your own mindset? Let's try and find out.
Okay, but before we jump right in, it's really, really important we state the source's disclaimer up front. This is crucial.
Right. Go ahead.
The information we're discussing today, it's purely educational material. It comes from extensive research and personal experience detailed in the source, but it is absolutely not investment advice.
Okay.
Nor is it an offer for any specific asset. Trading with leverage, it's inherently high risk. Any results mentioned in the source, they can't guarantee future outcomes.
So caution is key.
Extreme caution. The source strongly, strongly advises that you must apply all these concepts to a demo account first, for at least a full year.
A full year? Wow.
Yes, to really test their quality, their validity, before you even think about risking real capital. We're just sharing the insights from the material here. Got it. That's a critical foundation. So let's unpack this core idea then. What is the smart money concept, at its heart? Because it sounds like much more than just a trading strategy.
It is, exactly. SMC is described as, well, a comprehensive philosophy. It's about how financial markets actually function, sort of beneath the surface level.
Okay.
Its central theory suggests that market makers, these are the big entities like central banks, major institutional investors, Bank of America, UBS, Goldman Sachs, those kinds of players.
The giants.
The giants, yes. The theory is that they are incredibly powerful and exert significant influence. The claim is that they manipulate markets, making it tough for individual traders like us to consistently profit.
So it sounds like they're almost orchestrating things, but the source does offer a bit of a counterpoint right away, doesn't it?
It does, and it's an important nuance. While these huge players are undeniably the ones moving the market just because of the sheer volume of capital they control, the book states it's difficult to definitively say they actively seek to harm individual traders.
Ah, okay, so it's not necessarily personal.
Not necessarily. Their fundamental role, their main job, is actually to create liquidity. Think about it. Individual retail traders make up less than 5% of total market transactions.
Less than 5%? That's tiny.
It is. So the market makers aren't usually focused on wiping out Joe Trader. Their primary goal is to facilitate efficient trading by making sure there's always a buyer for every seller and vice versa. They need orders, lots of them, to fill their own massive positions.
That puts a different spin on it. So it's less about targeting individuals and more about fulfilling their own operational needs for liquidity, which means if we understand their mechanics.
Exactly. We might be able to anticipate where they need to move price to gather that liquidity and maybe, just maybe, ride their coattails.
Okay, that makes sense. And this brings us neatly to market structure, or MST. The source calls it the market's language. It's not just random lines on a chart.
That's absolutely right. The market tends to move in three primary phases, not just simple shapes. You have an uptrend, where prices are clearly moving higher, a downtrend, where prices are consistently falling,
Right.
and a sideways phase, which indicates, well, no clear direction. Consolidation, basically.
And within those trends, we look for specific patterns.
Precisely. In an uptrend, you'll see higher highs, or HH, and higher lows, HL. Each peak is higher than the last peak, and each trough is higher than the last trough.
Makes sense.
Conversely, a downtrend shows lower highs, LH, and lower lows, LL. Understanding these basic building blocks, HH, HL, LH, LL, that's really the first step to reading the market like SMC suggests.
Okay, basic structure. Now, within these trends, there are critical signals. One is the break of structure, BOS. This sounds like it confirms the trend is, well, continuing.
It does. BOS confirms trend continuation, so price breaking a previous high in an uptrend or a previous low in a downtrend. But, and this is a very important distinction the source makes, not all breaks are created equal. Some are potentially traps.
Ugh, the traps again. Okay, tell me more.
Right. So the strongest confirmation, what SMC calls a true break of structure, is when a candle closes decisively above a previous high in an uptrend or below a previous low in a downtrend, a full body close.
Okay, a solid close.
That's your strong signal. But here's the common trap. Sometimes price breaks the previous high or low only with a wick. The candle body itself doesn't close beyond that level.
Just the shadow pokes through.
Exactly. According to the source, this is often not a true break. It's more likely a liquidity sweep or a liquidity grab. Market makers might just be reaching up or down to collect orders sitting there.
Before potentially reversing or doing something unexpected.
Precisely. Now, there's a third type mentioned. If you get that wick break, but then another subsequent candle does close beyond the original high or low, ignoring the first wick, then that is considered a true BOS.
Okay, so the first wick break is suspect, but a follow-through close confirms it. That's a really crucial detail for avoiding false signals.
It absolutely is. Separating a genuine move from a potential setup, a liquidity grab, is key.
And if the trend is actually changing direction, what's the signal for that?
That's called a change of character, or CHOCH. Think of it as the market's personality shifting.
Change of character, I like that.
Yeah. CHOCH happens when a true low gets broken in an established uptrend, or a true high gets broken in a downtrend. It's the first sign that the prevailing trend might be losing steam and reversing.
And does the wick versus close rule apply here too?
It does, exactly the same logic. The
Right.
strongest CHOCH is confirmed by a full candle body closing beyond that critical high or low. A wick-only break. Again, could just be a liquidity sweep. It signals caution, maybe that a change could be coming, but it's not the confirmed reversal signal like a solid close is.
Got it. So you need that solid confirmation for both BOS and CHOCH. This level of precision seems really central to SMC.
It is. It's about trying to read the market's intentions, not just reacting to surface noise.
Okay, this is fascinating. Now let's get into some of the more advanced SMC tools. And first up is something called inducement, or IDM. This sounds exactly like one of those traps we mentioned earlier.
It pretty much is. Inducement, IDM, is described in the source as, well, a trap, often intentionally set, it suggests, by market makers.
How does it work?
It's an area on the chart where price might look like it's about to reverse. It pulls back, maybe forms a small support or resistance level.
Tempting traders to jump in early.
Exactly. It draws in those early retail traders. But according to SMC, it's not a valid entry point yet. The key insight here, the way you identify IDM, is that it's always the last corrective pullback, the last little wiggle, within the current real high or low of the established trend.
The last pullback before the real move.
That's the idea. Think of it as bait. The theory is market makers want traders to bite on that apparent reversal point so they can gather liquidity before moving price strongly in the other direction, often taking out the stops of those early entrants.
Wow. Okay. And the source even mentions an internal inducement, a trap within a trap.
Yes, IDMT. It adds another layer. If price only sweeps this internal inducement, this smaller, earlier pullback, then it's highly likely, according to the source, that price will then continue on to sweep the main inducement, the last pullback we talked about.
So you need to wait for the real inducement to be taken out.
That's the concept. It highlights how precise these alleged setups can be. And it connects to defining true highs and lows in SMC. A high or low is only considered true or confirmed if price has first swept an inducement and then achieved a break of structure, BOS.
Swept inducement, then BOS. Okay, that clarifies the sequence. It's all about anticipating where the big players need to go to collect orders.
That's the core philosophy, yes.
All right, next up, imbalance, or IMB, market gaps. What are these about?
Imbalance, or IMB, sometimes called fair value gaps, FVG in other contexts, is basically an inefficiency. It's a gap you see between candles on the chart.
Like a space.
Exactly, a visible gap, usually between the wick of one candle and the wick of the candle 2 periods later. It's typically created by very strong, rapid buy or sell orders, usually from institutional players moving the market quickly. And why is that important? The crucial takeaway is that price often revisits these areas. These gaps tend to act like magnets, drawing price back to fill that inefficiency.
To close the gap.
To mitigate it, yes. Though it's important to note, price doesn't always fill the entire imbalance perfectly. Sometimes it just reacts strongly at the edge of the imbalance. But these IMB zones can be powerful areas for potential entries, especially if they align with another key SMC concept, the order block.
Ah, perfect segue. Order blocks OB and order flow, OF. These sound like we're looking directly at the institutional footprints.
You could say that. Order flow OF is more about the overall directional pressure. It's described as the last significant buying movement before a drop in price in a downtrend, or the last significant selling movement before a rise in an uptrend. It shows where the institutional weight was last applied before a major shift.
The origin of the move.
Kind of, yeah. And the order block OB is more specific. It's a really key SMC concept. It's pinpointed as the specific candle, or maybe a small price area, right at the origin of that significant move where market makers are believed to have entered their large positions.
How do you identify a strong order block?
Well, for an OB to be considered true or high probability in SMC terms, it generally needs to meet certain criteria. It should ideally have swept some prior liquidity, like taking out a previous high or low.
Okay.
And it must be followed by an imbalance, that gap we just discussed. That imbalance confirms the strength and validity of the move originating from the OB.
Swept liquidity and created imbalance. Got it.
And another fascinating detail from the source, a valid OB is generally considered most potent for the first, maybe second, time price returns to it. After that, its significance tends to diminish. They get mitigated.
So they have a limited shelf life, in a way. It really feels like trying to decode the market maker's game plan.
That's the essence of SMC, trying to read between the lines of price action.
Okay, let's talk about the market's fuel. Liquidity, or LQD. This seems central, and the source makes some pretty strong claims here about manipulation.
Yes, this is a point the source emphasizes quite heavily, and it really shifts your perspective if you take it on board. Liquidity is defined simply as specific price areas where lots of buy or sell orders are clustered together. Stop losses, entry orders.
Pools of orders.
Exactly. It's the fuel the market needs to move. Now, the source directly states that highly liquid markets think Forex, commodities, cryptocurrencies are often manipulated.
By whom?
By the big players. Banks, whales, large institutions with vast amounts of capital. These market makers, as the source describes them, are believed to aim to remove retail traders from the market.
How? By triggering their stop losses.
Essentially, yes. Taking their orders, absorbing that liquidity before initiating a large directional move in the opposite way. The idea isn't just a theory in SMC. It's presented as a core belief. Market makers need that retail liquidity, those orders, to efficiently enter and exit their own enormous positions.
Wow. That's a powerful and definitely controversial claim. It paints a picture of a hidden game being played beneath the surface.
It does. And the source goes on to outline common liquidity patterns things traders can look for, like equal bottoms, EB, or equal peaks, EP, where price hits the same low or high multiple times, creating obvious pool of stops just beyond.
Like a magnet for price.
Exactly. Or uneven bottoms, UB, and uneven tops, UT, trendline liquidity, UDQY, DLQY. Recognizing these patterns, according to SMC, helps you anticipate where the traps, the liquidity grabs, are likely being set.
So you can avoid them or even use them to your advantage.
That's the goal. There's also a related concept called engineering fluidity, or ENFLD. It's defined as the first corrective pullback in a new trend, which contrasts with inducement, IDM, which is the last pullback within a leg of the trend. Just another way the source describes how liquidity gets structured or engineered.
Okay. And if we want to spot institutional involvement more directly, there's the institutional funding candle, or IFC.
Yes, the IFC. This is described as a specific candle pattern. It appears when price sweeps liquidity, like taking out a true high-low or an inducement, but does so only with a wick. Crucially, the candle body does not close beyond that liquidity level.
Another wick grab, basically.
A very specific kind. It's seen as a precise visual cue that institutions might be funding positions there, entering the market at that level without causing a decisive break yet. And interestingly, no imbalance is necessarily required right after an IFC for it to be considered valid.
Okay. Subtle but significant. Now, moving from these specific candle patterns to broader tools, Fibonacci retracement, or FIBO, gets mentioned. It's used everywhere in trading. How does it fit into SMC?
Right. Fibonacci is a very common tool.
Okay.
In the context of SMC, as presented in the source, its primary use is to identify potential reversal zones, especially during pullbacks within a trend.
Which levels are key?
The source specifies the golden zones for SMC as being deeper levels, 0.7 or 70%, 0.75, 0.8, and 0.85 retracements.
Deeper than the usual 50 or 61.8.
Generally, yes. But here's a really important caveat from the source material. Fibonacci is only used as a point of interest if there's no clear order block present in that area of the structure.
So the order block takes priority.
Absolutely. If a valid OB exists, it overrides the Fibonacci levels. The OB is considered the primary institutional footprint. Fib is more of a secondary tool, a backup if you like, when there's no clear OB to work with.
Good clarification. OB first, Fib second. What about the Banks candle, BCD? Sounds like it's linked to major news events.
You're spot on. Banks candles, or BCDs, are described as very powerful large candles, often triggered by significant economic news releases. Think interest rate decisions, NFP reports, that kind of thing.
What defines them?
They need to be significantly larger than recent candles, typically double the volume and size, and must engulf at least 4 preceding candles. Big momentum.
Any other conditions?
Yes, they must occur in the direction of the prevailing trend, and they must have wicks. The high or low of the wick itself becomes the key price of interest, the POI, for potential future interaction. These signal a strong, decisive move by market makers, often related to news.
Okay, strong news-driven candles. Then there's the flip zone, FZ, mentioned as an entry method, something about supply turning into demand.
Exactly. A flip zone describes a scenario where a supply zone fails, gets broken, and then transforms into a demand zone, or vice versa, demand flipping to supply. It often happens around a change of character, CH, signaling a shift in control.
How does it form exactly?
Price interacts with an existing demand or supply zone, fails to respect it, breaks through it, and then the market reverses direction, CH. That broken zone now potentially acts as support, if it was supply, or resistance, if it was demand, when price returns to it.
And is there a key rule for trading these?
Yes, and the force emphasizes this as critical, non-negotiable. To consider entering a trade from a flip zone, price must have swept an inducement IDM before returning to the flip zone.
IDM sweep first, then the flip zone entry.
That rule is paramount for almost any entry confirmation in SMC, according to this material. It aims to ensure you're not entering too early, before liquidity has been properly manipulated or gathered.
That makes sense, tying it back to the core ideas. Okay, finally, to bring all these concepts together across different market views, the source talks about frame bonding, FB, or multi-time frame analysis.
Yes, frame bonding, or simply multi-time frame analysis.
Yeah.
This is fundamental. It stresses the importance of using multiple time frames together to get a complete picture.
How does that work in practice?
You'd use a higher time frame, HTF, like the daily or weekly chart, to determine the overall market direction, the main trend. Then you drop down to mid-time frames, MPF, say the 4-hour or 1 hour, to identify the more detailed market structure, the BOS and CH, the key zones like OBs or IMBs.
And then for the actual entry?
You might drop even lower to lower time frames, LTF, like the 50-minute or even 1-minute chart, to look for specific entry confirmations, maybe a smaller CH or a refined entry within your HTF zone.
So top-down analysis.
Exactly. It connects different time frames to different trading styles, too. Long-term traders might focus on monthly, weekly, daily. Short-term or swing traders on daily 4H, 1H. Day traders might use 1H down to 1M. The core strategy is always analyze on a higher time frame for context and bias, then execute or refine on a lower time frame for precision.
It's like using, I don't know, a satellite view, then a map, then street view to find a specific address.
That's a great analogy. It provides context and detail working together.
Okay, we've really dug into the technical mechanics of SMC, but now we pivot. Because the source, and many traders, argue that the most crucial element for success isn't the charts at all, it's trading psychology.
This is, without a doubt, where the real battle is often won or lost. It's absolutely critical. The source even cites the American psychologist Van Tharp, who's a renowned coach for top traders.
What does he say?
Tharp states quite unequivocally that trading success is maybe 60% psychology, 30% money management or risk control, and only about 10% your actual trading strategy or system.
60% psychology, only 10% strategy.
Yeah.
That's huge. It really turns conventional thinking on its head, doesn't it?
It really does. It emphasizes that your mindset, your emotional discipline, how you react to wins and losses, that dictates your decisions far more powerfully than knowing any specific chart pattern or entry signal.
Okay, so if psychology is 60%, what are the major psychological pitfalls we as traders need to be aware of? What does the source highlight?
It identifies several key enemies within. First, there's fear. It's called the main enemy. This is what makes you close profitable trades way too early, scared of giving back profits, or panic sell when a trade goes slightly against you.
That knot in your stomach feeling?
Exactly. Then there's its close cousin, FOMO. The fear of missing out. Chasing trades that have already taken off, jumping in without a plan because you see something moving fast, regretting not buying Bitcoin years ago. It leads to impulsive, often disastrous decisions.
We've all felt FOMO, I think.
Absolutely. Then there's greed. This leads to overtrading, taking too many setups, setting wildly unrealistic profit targets, or holding on to winning trades for far too long, hoping for more, only to see them turn into losers.
Trying to squeeze every last drop out.
Right. The source also points to denial of errors, blaming the market, the broker, the algorithm, anything but acknowledging your own mistake in analysis or execution. This completely blocks learning.
You can't fix what you don't admit is broken.
Precisely. And finally, a really dangerous one, the inability to admit losses. Just refusing to close a losing trade, hoping it'll come back, moving your stop loss further away. This can absolutely destroy your capital. These are the silent killers in trading.
That sounds like a psychological minefield. So how do we navigate it? What are the key tips from the source to avoid these emotional traps?
Okay, the source offers some clear, practical advice. First, patience. It's crucial. You have to wait for your setup according to your plan, stick to your analysis, don't force trades.
Easier said than done sometimes.
Oh, absolutely. That's why the second point is critical. Have a detailed trading plan. This needs to cover everything. Your entry criteria, exit rules, both for profit and loss, your budget, your risk controls per trade, the strategies you'll use, and then the hard part, follow it strictly. No exceptions.
Discipline.
Discipline is key. Third, manage your wins. After a good trade, avoid getting overconfident, thinking you're suddenly a trading genius. Stay humble, reevaluate the market objectively for the next trade. Don't let one win lead to reckless behavior.
Right, avoid the guru illusion.
Exactly. And fourth, manage your losses. This is huge. When you take a loss, step back. Take a break. Don't immediately jump back in trying to make it back. That's revenge trading, and it rarely ends well. Reflect on the mistake, learn from it, then move on calmly.
That reflective part is so important. And actually, if you found this discussion on psychology and managing biases really interesting, we have explored similar themes about human behavior and decision-making in some of our past deep dives. You might find those really valuable too.
Good point. Understanding these biases goes way beyond just trading.
Definitely. Okay, so psychology is massive. The other pillar supporting it, according to Van Tharp and the source, is that 30% chunk, robust risk management. This feels like the absolute foundation, the bedrock.
It absolutely is non-negotiable.
Uh,
The source uses a great analogy. Trading without proper risk management, especially stop losses, is like driving a car without brakes.
you wouldn't do it.
You just wouldn't. It's going to end badly eventually. A stop loss is essential, and once you set it based on your plan, you never move it further away to accommodate a losing trade. Never. Its sole purpose is to limit your potential loss on that specific trade and protect your overall capital. It ensures you can survive to trade another day.
Protecting capital is job number one. What about the risk-reward ratio? We see these crazy numbers thrown around online sometimes.
Yeah, you see these claims of 1 to 100 risk-reward trades on social media. The source rightly challenges this. The risk-reward ratio is simply how much you stand to potentially gain versus how much you're risking on a trade. For example, risking $100 to potentially make $500 is a 1.5 ratio.
Okay.
The source emphasizes that excellent, realistic, and achievable risk-reward ratios in practice are more typically in the range of 1.5 onto maybe 1.20 on really good setups. Achieving even these requires that emotional discipline and patience we talked about. Emotional trading, chasing price, poor entries that kills your RR potential.
So realistic expectations are key.
Very key. Remember, trading is a game of risk and reward. Always think about the risk first, then the potential profit. Solid risk management is what enables consistent profitability over the long run, even if you only win, say, 50% or 60% of your trades.
And the source lays out some very specific capital management rules, doesn't it? Like hard limits.
It does, and they are strict. First is the 1% rule. Never risk more than 1% of your total trading capital on any single trade. This limits the damage from any one loss.
Only 1%.
Then there's a daily loss limit, suggested at 3%. If you hit a drawdown of 3% of your capital in a single trading day, you must stop trading immediately. Shut down the platform, review your errors, take a break, clear your head. This prevents digging a deeper hole through revenge trading.
Stop the bleeding, basically.
Exactly. If losses mount and you reach a 10% capital loss overall, the source says you're in a difficult position. This usually happens because the 1% and 3% rules weren't followed strictly.
A serious warning sign.
A very serious one. And the final, starkest warning comes if you hit a 20% capital loss. At this point, the source bluntly advises you to stop trading permanently.
Permanently. Wow.
Yes. Stop, reassess everything, create a completely new plan, perhaps get more education, maybe realize trading isn't for you. A 20% loss often stems from excessive random trading, breaking all the rules, or maybe starting with far too little capital in the first place, like just $100, where any small loss is a huge percentage hit.
Those are some sobering rules, but absolutely crucial for survival, it sounds like.
Survival is the name of the game first. Profitability follows survival.
Now, speaking of capital, for many people starting out, or even experienced traders, having enough capital to trade meaningfully without risking life savings is a huge hurdle. The source introduces a potential solution here. Funding companies or prop firms. What are these?
Right. Funding companies or proprietary trading firms that offer funding challenges present a really interesting alternative. Instead of using your own money, they evaluate your trading skills, usually through a specific challenge or evaluation period with set rules and profit targets.
Like a test.
Exactly, a performance test. If you successfully pass their evaluation, proving you can trade profitably while managing risk according to their rules,
None of what happens.
then they provide you with their own company capital to trade, sometimes substantial amounts, tens or hundreds of thousands of dollars. You then trade their money and you share the profits. Typically, the trader gets the lion's share, often 80% or even 90% of the profits generated.
Wow, so you get access to significant capital without risking your own shirt. What are the main advantages?
Well, the big one is obviously access to substantial capital you might not have otherwise. There's also a wide variety of these funding companies now, so you have choices.
Okay.
Another interesting advantage is that there's strict risk management rules, the daily loss limits, max drawdown rules they impose during the challenge, and on the funded account can actually force you to be more disciplined. They can help traders overcome some of those psychological pitfalls we discussed by imposing external structure.
Like built-in guardrails.
Precisely. They also generally offer global accessibility and often provide high leverage, like 1.10 wells, which can be beneficial if used responsibly within their risk rules.
That sounds potentially very powerful, but I imagine choosing the right funding company is important, especially with so many out there now. Any advice from the source on that?
Yes, definitely. The source suggests looking for established companies, ones with a good reputation, a solid track record, and decent market share. That implies stability.
Makes sense.
Critically, it advises choosing companies whose evaluation periods have no time limits. This removes unnecessary pressure to hit profit targets within, say, 30 days, which can lead to forcing trades.
No time pressure. That's a big one.
Huge. Also, try to avoid companies that charge recurring monthly fees. Opt for ones with a one-time evaluation fee. Ensure they offer reliable and convenient methods for both deposits, for the fee, and withdrawals for your profit share.
Good practical points.
And probably the most important point, always thoroughly read and understand all the rules, terms, and conditions associated with their challenges and funded accounts before you sign up and pay the fee. The devil is always in the details.
Yeah, read the fine print.
Always, always. Ultimately, the key to success with funding companies, just like with trading your own capital, comes down to that strict adherence to risk management. That's what gets you through the challenge and keeps you funded long term.
Risk management again. It really is the common thread through all of this.
It truly is.
And speaking of platforms and getting started, we actually wanted to share something relevant here. You know, with the unfortunate spread of scam platforms out there, finding a safe place to trade and invest is really important.
Absolutely critical.
So we've looked into it, and we can point you towards a secure, globally recognized platform. It's considered one of the best for investment, allowing you to trade stocks, gold, forex currency pairs, and many other markets.
And importantly, it's known for being very fast and reliable with both deposits and withdrawals.
Right. And they're offering a pretty significant bonus, 50% on your first deposit. If that's something you're interested in exploring, you'll find the link for that specific platform down in the description below this deep dive.
And building on that, for those of you who really want to go deeper, maybe learn trading and investment professionally right from the ground up.
Yes.
There's also a comprehensive professional course available that covers everything from the basics to advanced strategies. It's designed to take you from zero to a professional level of understanding.
Okay, great. And where can people find that?
We've put the link for that course in the description below as well. So platform link and course link, both there for you if you want to check them out. Resources to help apply some of these concepts.
Fantastic. Wow, what a deep dive this has been. We've really journeyed through the smart money concept, haven't we? From trying to decipher market maker intentions and understanding all that intricate structure, BOS, HO, CH, IDM, OBs.
All the acronyms.
Haha, yes. All the way to the absolutely profound importance of mastering your own psychology and nailing down that risk management.
It really is a comprehensive approach, isn't it? It demands both analytical rigor in reading the charts and deep self-awareness in managing yourself. The core idea that markets might be fundamentally influenced and that spotting the alleged traps is key certainly gives you a lot to think about.
It absolutely does. So as you, our listeners, reflect on everything we've discussed today, here are a few provocative questions, just something to mull over, building on these ideas.
First, considering those traps or inducements supposedly set by market makers, what seemingly attractive opportunities or situations in your own life outside of trading might actually be inducements drawing you into an unfavorable position?
Ooh, that's deep. Second, if trading success truly is 60% psychology, where else in your daily life, your career, your relationships, your health, could a deliberate shift in your mindset yield similarly disproportionately large returns?
And third, how might the discipline required for strict risk management and high-stakes trading, that constant assessment of potential loss versus potential gain, be applied effectively to other areas where you face uncertainty or potential loss, maybe in big career choices or even personal relationships?
Really powerful questions to ponder. We genuinely love hearing your thoughts and experiences too. So if there's a specific topic you'd like us to tackle in a future deep dive, please do let us know in the comment section below.
Definitely. And if you found this deep dive valuable today, if it gave you some food for thought, please don't forget to subscribe to the channel so you don't miss future explorations.
Absolutely. And as we mentioned, you'll find links to the original source material we discussed, the Adama's 0.1 document, plus those platform and course links and other important resources, all listed in the description right below.
Check those out.
So today, we peeled back the layers on the smart money concept, trading psychology, and risk. We regularly explore fascinating topics like this, aiming to help you become better informed and make sharper decisions in complex areas.
Keep an eye out for our next deep dive.
Yes, and remember to check out our previous deep dives as well, where we've explored related areas like complex systems analysis and the deep psychology of decision-making. Thanks for joining us.